Ever feel like you're looking at stock charts and they're just speaking some kind of secret language to you?
Mm-hmm.
Well, get ready to become fluent because in today's deep dive, we are cracking the code of technical analysis.
That's right. We're diving deep into the classic technical analysis of the financial markets by John Murphy. Really helped to equip you with the tools that traders use every single day.
And listeners sent in a ton of questions about this one, so we're going to make sure we cover everything really, really thoroughly.
Absolutely.
So let's start with the basics. What exactly is technical analysis, and how does it differ from fundamental analysis?
So when we talk about technical analysis, we're talking about focusing on the effects of market movements, what we call price action.
Okay.
And I think a good analogy is to think of it like detective work, right?
Okay, I like that.
So fundamental analysts want to know why a crime happened.
Right.
But technical analysts, we look at the clues left behind at the crime scene to figure out how.
I see. So instead of earnings reports and economic data, we're looking at patterns in the charts themselves.
Exactly. Technical analysis basically operates on the idea that everything you need to know is already reflected in the price.
Interesting.
Those price swings, those trends, they tell a story about the underlying supply and demand dynamics of that asset.
So even if a company, for instance, has, a great product and a solid business plan, if investors aren't buying it, the charts are going to reveal that.
Precisely. In fact, Murphy argues that while technical analysis can certainly stand alone as its own discipline, he says that fundamental analysis is actually incomplete without understanding price action.
Now, that's a very interesting take because a lot of people would say, well, if you think this is a good long-term investment, just buy it and forget about it. But you're saying even in that instance, if you ignore the charts, you might be missing out on crucial insights into your entry and exit points.
Exactly. You want to buy low and sell high.
Exactly.
That technical analysis can help with that.
Okay. So is it fair to say that this is a very versatile approach? Can it be applied across stocks, futures, options, any trading medium?
Yeah, that's the great thing about technical analysis is that it's a universal language,
Okay.
So it could be applied across stocks, futures, options, really any trading medium.
And I would imagine it works on different time frames too. So whether you're, somebody who's a day trader or a long-term investor, the principles kind of remain the same.
That's right.
Yeah.
Works across different time frames. So whether you're looking at minute-by-minute price movements or whether you're looking at monthly charts, the techniques still apply. And actually, Murphy highlights this, the importance of technical analysis in futures trading. Because in futures trading, even if you're slightly off with your timing, due to the high leverage it can be, a very, very big difference.
The stakes are higher, so you need every advantage you can get.
Yeah.
Now, I know some people, they hear about technical analysis and they're very skeptical. They think, oh, you're just looking in the rearview mirror. You're trying to predict the future. So how does Murphy address that skepticism?
So he acknowledges that, critics of technical analysis bring up valid points.
Right.
So, like you said, trying to predict the future, the idea of self-fulfilling prophecy, limitations of past data, But he says they're missing a key point.
Which
is that technical analysis isn't about guaranteeing what the future holds. It's about identifying probabilities based on historical patterns.
So it's more like we're not saying this is definitely going to happen. We're just saying this is more likely to happen.
Right, exactly. Like certain market behaviors tend to repeat themselves.
Got it.
Over and over again.
And the random walk theory, which says that everything just moves randomly, obviously Murphy doesn't subscribe to that.
No, and he would contend that in volatile markets, especially like commodities, the trends are too evident to ignore.
So don't discount the power of patterns, especially in those markets that are prone to big swings.
Yep.
Okay, so we've kind of laid the groundwork here. Let's dive into the language of the charts themselves. What's the first thing that somebody who's totally new to this needs to understand?
So I think we have to start with the granddaddy of them all, which is the Dow theory.
Okay.
And the Dow theory, it's not a trading strategy in itself, but it's a framework for understanding how markets move.
Okay, so kind of required reading for anybody who really wants to understand this stuff.
Absolutely. And, we could probably do a whole nother deep dive on just the Dow theory. But I think for our purposes today, there's two of the tenets that are important.
Right.
One is that market averages discount everything.
Okay.
Which means that the current price reflects all known information.
So all news, all economic data, even rumors, everything's already baked into mail.
It's already there.
It's the price. We don't need to obsess over every little headline. It's all there.
Exactly.
Okay.
And then the second one that's important is that trends have three phases:
Okay.
accumulation, participation, and then distribution.
So knowing where we are in that cycle, I would imagine, is very helpful.
Hugely important.
So, if we see something going up, we want to know, is this the beginning of something big? Or is this just a blip?
Exactly.
Okay. And that leads us, I guess, into trend analysis itself, which you said is kind of the backbone of technical analysis.
Yeah, the backbone. Yeah, it underpins everything.
So what exactly are we looking for when we talk about trend analysis?
So trend analysis is really about identifying a series of ascending or descending peaks and troughs. So it's not just about focusing on single price movements.
Okay. So we're looking for patterns of highs and lows to determine the direction of the trend.
Exactly.
Got it. And what role does psychology play in all of this? Because obviously the markets are driven by humans. Humans are emotional beings.
Yeah, it's everything, right?
Yeah.
Trends are fueled by fear and greed, right?
Yeah.
So as prices rise, greed kicks in, right? Pushing prices higher. When they fall, fear takes over and prices plummet even further.
Right.
And this creates what we call support and resistance levels.
Okay, so explain those.
So support is like a floor beneath which prices struggle to fall, right?
Okay.
And resistance is like a ceiling.
A ceiling, got it.
That they have difficulty breaking through.
So buyers come in at the support level, sellers come in at the resistance level.
Yeah. You got it. And what's interesting is that Murphy highlights three factors that really determine the strength of those levels.
Okay, what are they?
So one is price action density.
Okay.
The second is volume traded at those levels.
Okay.
And the third is the recency of trading activity.
So a support level that's been tested multiple times and it's held is probably stronger than one that's only been tested once or twice.
Exactly. High volume at those levels also indicates, strong conviction from traders.
Yeah.
And then, naturally levels tested more recently are fresher in traders' minds.
Right. So if it was tested, last week as opposed to 6 months ago, it's more likely to be a key level.
Exactly.
Got it. So we understand support and resistance now. How do we start to actually put that into practice by looking at charts? What tools do we have?
So we can actually start visualizing these levels using trend lines and channels.
Okay.
And trend lines are simply lines that we draw on a chart connecting the peaks in a downtrend or the troughs in an uptrend, giving us a clear visual representation of those key support and resistance levels.
So when those lines break, that's when it might be signaling a change in direction for the market.
Exactly. And what's really cool is Murphy, he even offers this measuring rule to project potential price targets after those breakouts occur.
Interesting.
Yeah, and then we have channels. So channels are formed by two parallel trend lines.
So it's bouncing between the two.
Exactly.
Okay.
And channels can help us identify potential overbought and oversold conditions.
Got it.
But moving on to, I think, even more fascinating stuff is, we can start talking about chart patterns.
Okay, yeah. This is where it starts to feel like we're really deciphering some kind of secret code.
Yeah.
So what are chart patterns?
So chart patterns are essentially formations that appear on our charts that signal potential trend reversals or continuations.
Oh, okay.
They're like visual clues that tell us what might happen next.
Okay.
So, for example, one of the most well-known reversal patterns is the head and shoulders pattern.
Head and shoulders, what is that, like a shampoo commercial?
Yeah, so it's named for its shape.
Okay.
Right? We're looking for three peaks.
Okay.
The middle peak,
Yeah.
the head being the highest,
Okay.
and then the two outer peaks, the shoulders, being roughly the same height.
I can picture it, yeah. I can picture it.
Yeah. And so the idea is that when the price breaks below the neckline, which is the line connecting the two shoulders, that signals a potential reversal to the downside.
Got it. So we're looking for it to break through that neckline. And again, is volume important here?
Oh, volume is crucial for confirmation.
Okay.
Right. So we want to see strong volume on the initial rally to the head, but then weaker volume on the rallies to the shoulders.
So it's almost like it's losing steam.
Exactly.
As it goes up.
Exactly.
Okay. What about continuation patterns? What are those?
So continuation patterns suggest that the current trend will resume.
Okay.
After a pause or consolidation phase.
Okay.
So a good example here is triangles, right? You got symmetrical triangles, ascending triangles, descending triangles,
Yeah.
and these patterns are formed by converging trend lines.
So it's almost like the market's, taking a breather.
Yeah, exactly. It's just consolidating, gathering energy.
Gathering energy, and then it's going to make a move. And those converging trend lines are giving us a clue as to, like, when that move might happen.
Yeah, okay.
Cool.
And then you got other continuation patterns.
Yeah.
Like flags and pennants,
Okay.
which represent these brief pauses within strong trends.
So those are like the quick pit stops, refuel, and then we're off to the races again.
A perfect analogy.
Okay, now this is all very, very interesting, but I imagine that, it's very easy to get carried away. We start seeing these patterns everywhere. We think we found the Holy Grail. So what's the most important thing to keep in mind?
So while these chart patterns can seem like magic keys unlocking market secrets,
Right.
it's crucial to remember that volume analysis is absolutely key
Okay.
to confirming the validity of these patterns.
So we shouldn't get too excited just because we think we see, a head and shoulders pattern forming.
Precisely, yeah.
Yeah.
Focusing solely on price action without considering volume is it's a recipe for disaster. It's a common mistake that a lot of newcomers make.
It's like thinking you struck gold because you found a shiny rock, but you didn't even bother to check if it was real gold yet.
Exactly. Yeah, volume it's like the heartbeat of the market,
Okay.
right? It gives you that valuable insight into the conviction behind those price movements.
So how do we actually start to incorporate volume into our analysis? What are we looking for?
So a general rule of thumb is that volume should increase in the direction of the prevailing trend.
Okay.
Right.
So in an uptrend, we want to see the volume expanding on those rallies.
Yes.
And then contracting when it pulls back.
Exactly. Yeah, strong volume on rallies tells you buyers are enthusiastic, they're confident.
They're jumping in.
Exactly. And then weaker volume on pullbacks suggests that sellers are hesitant. Right.
Mm-hmm.
So it's really confirming the strength of that trend.
Now, we've been talking a lot about stocks. We've mentioned futures. And, like we talked about at the beginning, you could apply this to a lot of different markets. Is there anything specific about using volume when we're talking about futures trading?
That's a great question. And yeah, when it comes to futures, we actually have an additional tool at our disposal,
Okay.
which is open interest.
Open interest. Yeah. Remind me again what that is.
Sure. So open interest refers to the total number of outstanding futures contracts
Okay.
that haven't been settled.
Okay.
So it's basically giving us a glimpse into the flow of money
Okay.
coming into and out of that market.
So it's not just how many people are trading, but how much is actually at stake.
Exactly. And here's, I think, the key is how do we interpret
Yes.
open interest in relation to price trends, right? It can be a very, very powerful confirmation tool.
Okay, so give me the scenarios. What am I looking for?
Okay, so there's four main ones to remember. So the first is rising open interest in an uptrend.
Okay.
That's bullish,
Okay.
right? It means new money is flowing in, pushing those prices higher.
So it's like a vote of confidence from the market.
Precisely.
Mm.
Now, conversely, declining open interest in an uptrend, that's actually bearish,
Okay.
right? Because it might suggest that the rally is running out of steam
Okay.
and could be primarily driven by short covering at that point.
So those who bet against it are having to buy back in to cover their losses, which
Mhm.
creates this like artificial, price surge.
Exactly.
Okay.
Exactly. And the same logic then applies to downtrends.
Got it.
Right. So rising open interest in a downtrend,
Yeah.
bearish.
Okay.
New sellers are coming in. But declining open interest in a downtrend suggests that selling pressure might be waning
Okay.
and a potential reversal could be on the horizon.
So it's like this constant tug of war between the buyers and the sellers.
Absolutely.
And open interest can be a really good signal as to like which side has the upper hand
Ex-
at any given time. This has been incredibly insightful, but I got to be honest with you, it sounds like a lot to keep track of.
Yeah.
All these patterns and indicators and everything, it makes it seem like this is really just for like day traders who are, glued to their screens all day long.
Yeah, it's a common misconception.
Yeah.
While those short-term movements are important for sure, technical analysis is incredibly valuable for long-term investors as well.
Really? Okay, see, I'm more interested in the long game.
Right.
Like, I want to understand the big picture.
Sure.
So how does technical analysis help me with that?
So one of the key things is by shifting your focus, right, to weekly and monthly charts,
Okay.
you can actually identify those major trends
Okay.
that unfold over years, not days. And I think these long-term charts, they provide crucial context.
Okay.
Right. They tell a story about where the market has been, but more importantly, they can give us clues about where it might be headed.
It's almost like zooming out on a map, right?
Okay.
Instead of just looking at like one street corner, we're looking at like the whole state.
Exactly.
Got it. Now, and when we're playing that long game, there's another factor that we have to always keep in mind, which is inflation.
Yes, absolutely.
Right. Inflation, the silent killer of returns.
That's right.
So how does that tie into all of this? How do we factor that into our technical analysis?
It's all about perspective, right?
Okay.
What might seem like an impressive gain on a chart
Right.
might not be so impressive.
Right.
Once you adjust for the erosion of purchasing power.
Right. So if something's doubled in price over the last 20 years, but inflation has also doubled,
Yeah.
I'm like, you're further ahead.
Exactly.
Yeah.
So always consider the impact of inflation.
Got it. Very important. Well, listen, I feel like we've covered so much ground today. We started with like the real basics of technical analysis, what it is, how it's different from fundamental analysis. We talked about how to decipher all those like kind of cryptic chart patterns. We talked about the importance of volume and open interest. And then finally, how we can use all of this stuff for not just, short-term trading, but also long-term investing as well.
And, we've really just scratched the surface.
Right.
There's so much more to explore in the world of technical analysis.
Oh, so where do we go from here? Somebody's listening to this. They're like, okay, this is really interesting. I want to go deeper. What do they do?
I think, the beauty of technical analysis is that it's as much an art as it is a science.
Okay.
So now that you have a good foundational understanding, I think the best path forward is really just to explore.
Explore. What do you mean by that?
So, maybe you found, listening to this, that chart patterns are really interesting to you.
Okay.
Or maybe it's indicators.
Right.
Pick one.
Okay.
Pick one that really resonates with you and dive deep.
Okay.
Study historical charts, see how it plays out in different market conditions, backtest different trading strategies using that pattern or indicator.
So really going from like a general understanding to becoming a specialist in something that speaks to you?
Exactly, yeah.
Yeah.
And remember, technical analysis, it's not about, memorizing a rigid set of rules.
Right.
It's about developing a feel
Okay.
for market behavior.
Okay.
And the more you immerse yourself
Right.
in these charts, the more intuitive it will become.
Yeah. It's like learning a language. Right.
Exactly.
Immersion, practice, it all starts to make more sense. Yeah.
Absolutely.
Well, this has been fantastic. I feel much more confident. Gonna go out there and look at these charts and hopefully not lose all my money.
Hopefully make some money.
There you go. That's even better. Well, thank you so much for doing this. This was great. Really appreciate your insights.
It was my pleasure.
And to everyone listening, thanks for joining us for this deep dive into technical analysis. Until next time, happy charting.